Good morning, everybody. TGIF. Today is my wife's birthday, so when you guys get a chance, those who know her, hit her up on Discord and tell her happy birthday. All right, I'm getting some kind of error with TradingView. I don't know what's up with it. It's been acting like that all morning. Everything else seems to be fine. Red around the screen, red around the world. Hong Kong's down the most, more than 2.5%. The bond auction yesterday at 1 o'clock kicked off a really nice sell-off to the downside. It really looked like that was going to maybe offer us the capitulation lows that we have been looking for, and yet we rallied right back out of it again. So I was really hoping to find this morning that we were down considerably. It would give us this nice setup that we had, back in October, for an example. But we don't have it. So the rally up yesterday afternoon towards the end of the day, and then the continuation of it in the overnight, even though we did go back down and try to push into the lows again, we don't have the setup. I just noticed that TradingView on one of my machines is working and the other one isn't. So I don't know. $8:39 and 10 for the biggest economic events today. Banks are kicking off earnings season, and they usually set the tone. So if banks are having a hard time with their earnings, it's very likely a lot of other companies will. It's really important. I don't listen to earnings from every single company and from every sector. It just, a lot of it is just shenanigans and the same old, same old. But there's a couple of really big bank CEOs who will present their forward outlook, like Jamie Dimon, for an example, is out chipping his teeth. And their outlook is taken really serious by the street. So it's worth listening to what they have to say about what they see going forward for this quarter and into 2024, because that is what's going to set the tone, right? Not necessarily how they did, but what they see on the horizon. So over the weekend, it's really worth your time to kind of circle back and pick up the highlights from this. This year is going to be the first year where I get to use AI to assimilate all of this earnings data from today, from the bank. And of course, Monday, we got more banks on Monday. But you can point AI towards a massive amount of material that needs to be read and get summaries where it knocks like 85-90% of that reading down, and you can absorb a report in like 2 minutes. And this is going to be the first time where I actually target an entire earnings with it. We'll see how it goes, but the opportunity is there for you to go through and kind of get an idea of the forward outlook of things from multiple points of view without having to spend your entire weekend to do it. So something to consider, right? We've also got European Central Bank Christine Lagarde out speaking today. That's the European version of Powell, right? Except she's got bigger feet. Yeah. We are going to get some data out of Japan late tonight. It won't really impact us that much during the day today. We're going to get the rig count, but that really honestly shouldn't change much. And Yellen is over in China, or talking with China. They made sure to reiterate this phrase a couple of times now, and I don't know who they're trying to signal yet, but there's something in this worth digging down a little bit more if you have some time today or over the weekend. See what Yellen is up to with this substantive and productive working group. They tend to double layer things like that when they really want to get a point across, and those words can matter, just like when the Fed announces a pause, which they officially haven't done yet. When they do that, there's a weight to it, right? There's a historic precedence, so that when they do announce a pause, it means something. There's something to this. I don't know what it is yet. Yeah, I don't know what's up with TradingView. On this machine, I can't get TradingView even on the web, but on the other machine, it's working just fine. So I don't know what's up with it. Stupid TradingView. All right, looking at things on the week, we're still holding underneath that 50% mark. We didn't make it to the 20 period weekly moving average. We got close, but we didn't get there. And we did tag both of the weekly 10 period moving averages, and we're now back down underneath them. Depending on which 20 you use, we are underneath, and we are right now a 20 period moving average. I tend to keep them just laid in there together, so to me it doesn't matter if it's the EMA or the SMA, but if you need to know which one it is, it's the 10 EMA on the weekly, or excuse me, the 20 EMA on the weekly. We're right there right now, 43.80. So on the week, if we were to close right here on the week, it would still be considered a good week. We rallied up after gapping down. We're closing higher than last week's high. This would be seen as positive on the week if we were to just close here now. And that's how you would hear it on those generic little news places like CNN and Bloomberg News and, you know, those kind of places. This would be seen as a good week. If we measure the week that we have just gone through, you can see how we're closing above the 50% mark, at least for now. So that's kind of the benchmark for the day. If we keep that, right, it's kind of the point of it all. The symbol for this chart is ES. So depending on what platform you're on, that's \ES. Taking a look at the volume this morning from the overnight hours, this is cumulative volume. It's sitting at 133. That's within our norms. It's not overly light, not overly heavy. So it's okay. It's showing that they're in there participating. They're not waiting on any data this morning, but they are in here hedging as well. We can see that through the market maker move. So the market maker move just kind of gives us a heads up or a warning that they are in here hedging, and they would hedge if they deem that there's something today that's a threat and they want to protect their positions without having to exit their positions. So they're trading in the front end of the options. That's why we have this market maker move. So there's a lot on the screen. Let's just take this off because it's from yesterday and I didn't get a chance to put today's in. With that noise out of the way, things are a little bit cleaner. We talked about the weekly moving average. So we get that off of here. You can see we've been working with this 10-day. We hit it yesterday, cut through it, and came back above. Again in the overnight hours. So we are back above the 10-day, but we're flirting with it. Got a little bit of a threat against it. Swap this to a daily. You can see how we're tangled up in all of these moving averages. The 200-day moving average is what we hit yesterday. So a part of that steep decline. We also hit the ADR full. And one of the things that I wanted to show you on TradingView is I now have this indicator on TradingView and it shows previous days, which is fantastic because over the last few years when I've been using this indicator and showing you guys the range for the day, I'm never able to show you what we did yesterday. But now we can on TradingView, but TradingView won't load this morning. I don't know what's up. It's working on my other machine. But we hit the ADR full yesterday and we stopped. Now TradingView's version and my version, they're just a little off. On Thinkorswim, we hit it almost to the tick and reversed perfectly. On TradingView, we cut through it a little bit, but not enough to, break the narrative. Those ranges are really valuable. I couldn't stress enough how they offer insight onto the trading day. When we get through one and we continue moving towards the other, it becomes nearly guaranteed that we're going to go there. And in fact, on the rally back up, what we hit on that move back up was the red ADR, the ADR half. We rallied all the way back up and hit the underside of the ADR half. It's fantastic. So if you're not using these ADR levels for, at the very least, insight and perspective on the day, then you're missing out. It's a free indicator, doesn't cost you anything. On TradingView, you can just search for ADR multi-time frame, I think is what I found. So since I can't bring up TradingView, I took a picture from the other machine and just snapped it and brought it over real quick. Like I said, these levels don't match mine perfectly, but we hit yesterday the full ADR and we rallied all the way up. And on Thinkorswim, we hit the ADR from the underside. And it was my destination on that run back up. Like that's what I had in mind. Not right away. It's not like I was able to jack that right from the very beginning. But as we continued that advance higher, it started to become clear that, oh, hey, I think we're going to go and hit the other line. So that's what I traded to. So you can hunt for that. It's on TradingView. It's called ADR multi-time frame, something like that. And it has some moving averages tucked into it, and it's got multiple levels and multiple time frames. It does offer you weekly and monthly, which I had not been using a weekly expected move or a weekly ADR, but now that I have access to that sort of data, I think we're going to get more out of it. And I'm certainly looking for I'm looking for an opportunity to do some videos on this as well, now that we have that kind of data. Never been able to do a look back to show, how useful these are. And it's just math, right? We're only talking about an ADR, which is an average daily range. So we're looking at what a market does on a day-to-day basis over, say, the last 21 days. And then asking, what do we think it's going to do today? It's probably going to do the same thing it's been doing over the last 21 days, right? That kind of makes sense. Sure, things can break their norm and step out of line and do something that they don't normally do or hadn't normally been doing. But for the most part, things get their average because they are just being, they're just doing their normal business. Ten-day, 30-minute volume profile. We really don't have anything here today. We could consider it the classic D shape, but that's really all. I did mention yesterday that if we broke that low, we'd very likely move through that zone very fast, and that's exactly what happened. Shallow areas, we tend to move through them quickly. There's really not a lot here to carry with us today. We're not going to move. Well, let me rephrase that. It's very likely that we don't move the point of control back up to these highs unless we can cut back above that 4,400. Even if we were to cut through the 4,400, we still have to worry about the cog line at 4,411. We do have another air pocket below us. So if we break yesterday's low, it's very likely that we'll drop down into the 4432 cog line. So we laid out that new VPOC yesterday, and you can see how we came down and got a first touch play on it. I was busy, I didn't trade that one, but that's a nice representation of a first touch play. It's not designed to be a reversal that runs you back to the top. First touch plays usually can generate 5 to 7 points. It's not bad. Now we don't need it. It's been hit. Take it off. We didn't build one from yesterday because we've already crossed through that zone multiple times. Now the books will say carry forward your value area high and your value area low. I don't do that. I've already got enough pivots. I don't need any more. The value area low from yesterday is actually the low of the day from yesterday. So for me, I already have that level marked. And for the value area high, I just don't have a reason for that pivot. I don't need it. So, for me, I wouldn't mark it. But the books will say if you're using a volume profile to carry forward those 3 levels, I'd rather carry forward the open of yesterday, the RTH high of yesterday, and this pivot point right here. And don't forget, we have not closed that liquidity gap that I spoke about yesterday morning. We did in the NASDAQ, which was fantastic, but we didn't do it in the ES. Not yet. So that's a level worth carrying forward too. I mentioned the volume up here, but it's worth seeing it here on the daily or on a 5-minute rather than that higher time frame 30-minute chart. If we do break above our own Globex low and get through this pivot point right here, that 43.93, which is a yearly, quarterly, monthly, and weekly level that you should always have marked on your chart. If we can get through that, we've still got a lot of volume to work through at that 4,400 to 4,405 zone. It's interesting to note that it's not the round number, which is what we would normally be focused on any other market, right? Round numbers, hundreds, thousands, they're always big levels, but it hasn't been on the ES for a while. We keep skipping right past 4,400 as if it has no value to it. But 4403 or 4405, that's where a lot more volume has been taking place. I don't know why. A lot of times the why doesn't matter as long as we can recognize where it is and what we need to hit on. All right, so this is how wild the week has been. Every week, we start on Monday with this range in mind. We actually end on Friday with this week in mind, right? And we're going to close inside of that range 80% of the time in the ES or SPY or SPX. In the S&P, 80% of the time, we'll end the week inside that range. And after everything that's happened this week, we're higher than where we closed last Friday, and we're inside the range. In fact, all we've done this week is barely peek outside of the range and came right back in again. So in the grand scheme of things, this move off of the lows from early October is still valid and it's still in play. If you look at the textbooks where it talks about topping patterns and bottoming patterns, one of the things that we always want to focus on is what the books talk about. So you get the move to the downside, then you get the move to the upside, and we broke that level. And we get the pullback, and we've got a higher low. And we've got a higher high. That's a start. We've got to come back up, and we've got to break that level. The thing is, this spot, which is where we're at right now, it's not confirmed yet. We've come up off of that low. We've pulled back, but this isn't a pivot point yet. Until we come up, then we'll be able to say we got this whole thing right here. That'll be our very first. But if it doesn't go up here, if it continues to go down, then it's just a continuation. So we don't know yet. How we end today will be a good start. And if we come up and we break that high, then we've got our first higher low. And that's what we need. So far, we haven't invalidated the call that says we're aiming for ending the year closer to the highs than closer to last year's lows, right? Because that's kind of the argument right now. Are we going to be closer to the high or closer to last year's lows? Even just getting down to, say, March lows or December's lows. The October lows are 3,600. The year-to-date highs are 4,600. My argument has been that we're more likely to get back up here by the end of the year than to be down here by the end of the year. But there's a lot of bricks in the wall of worry. So whether or not we're going to be at one of these or the other is really dependent on what's going on other places, not this chart. What's happening with the 10-year, what's happening with our own government, what's happening with these wars that are kicking off around the world. There's so many bricks in that wall of worry that are going to impact this chart besides what we have in this chart to look at. The next thing of concern while we're sitting here on the daily is how this looks and how this looks, because that was a bottoming pattern and that was a good start, just like we're talking about, but it failed to set a new high and then it broke that low and we continued to the downside. So far, we just don't have enough information. We're at that point right there. What we usually do on Fridays, we measure the week that we just had, and we look forward to the week that we're about to get. Now, that new week that I just laid this box over, it's not set in stone yet. That won't lock into place until 4:15 tonight. But we can get an early gauge on the width of that range. The gray line that you see is current price. So it's moving up and down as price moves up and down. And the red and green line are based on the out of the money options implied volatility average, which comes from the options chain. There's been a lot of talk about this head and shoulders pattern. They've been covering it on stock charts and Investors Business Daily. And the thing is, when it comes to a head and shoulders pattern, once it breaks that low, we measure this distance to that distance and we plot it down here and we mark 50% of it too. And once we get that move and it pulls back nearly all the way back to the next line, that the head and shoulders is now done. It's done. And it has no more weight, no more bearing to it. So with that in mind, if this is a Busby off of that neckline, it should never have pulled back that far to still be a valid head and shoulders with a continuation of the full measure. Now it's just a head and shoulders that's done. You know, we'll use a generic box here just to make it easy to see where the potential neckline was at. Once we broke that, we could measure it. We made more than 50% of the neckline or the head and shoulders. So we made the 50% mark. It's done. The head and shoulders no longer has weight on our analysis and no longer has bearing or impact on the market's potential move. And we now just scrub it into the past and we look for another pattern. Yep. That was hard for me to get over. You know, I really struggled with head and shoulders. It's an abstract pattern, like looking at clouds in the sky. Some people see a lot of things when they look at the clouds and others don't. As a psychologist, we had to go through the Rorschach tests and the ink blot tests. And that's the same thing where you look at an ink blot and you see something in it. I am horrible at that. So abstract patterns are something that I just really struggle to see. And it took a lot of work to see head and shoulders. So when I finally started to see them, I was crazy, super excited about it. And I held their weight in my analysis way longer than I should. I would keep coming back to it and referencing, say, like this head and shoulders, and I wouldn't discount the fact that it was done because I was just so happy that I had found the darn thing and that I had been able to measure its targets. It played out this far. Maybe I can get more out of it. I can use it for more. But no. So letting it go once it's served its purpose is the best thing to do. And if it fails to even give you what it's supposed to give you and starts to pull back that far, then it's done as well. And you let it go there too. So cup and handles, head and shoulders, these multi-week patterns that form these really big ones, they're hard to let go of. But this one's done. Having said that, though, this is a Busby. And a Busby owes us that. If we are going to come down, that's what it owes us. Most technical analysis books will talk about this move to the downside. That's exactly what we have here. So it really needs to resolve this top after we get this pivot point here, if we're going to get a pivot point. Because the thing is, if we pull back and we just dump like we did back there, then this won't form a pivot at all. This is just, it's just going to fall right through it like it did back here. So that makes next week really important. How we open up, and then how we finish this this next week. So we need this to become a pivot point. And my argument is that we're going to be closer to the highs by the end of the year than the lows. And there's a lot of really rough things in that wall of worry that suggests the market is on a precipice and could fall right off the cliff. But we can't live there, right? We can't sit around trying to stay all bared up in our portfolios when the overwhelming evidence is still showing a market going to the upside against all odds and against all of the hand wringing and worry. We're continuing to advance to the upside. So I'm going to trade that until this pivot breaks, or until we don't get a pivot and it continues to come down and breaks this low. Then I'm obviously wrong at that point, and I'll join the bandwagon and take the short. To kind of reinforce that point of view, this is 5-day change in the top 9 sectors of our market. Across the top is the risk on markets, and across the bottom is the risk off markets. The ones in the middle are like we just call midline sectors. So our risk on sectors between finance, technology, consumer discretionary, in the last 5 days, all of them are up at least 1%. Tech is up more than 3.5% over the last 5 days, including yesterday's big sell-off. The midline sectors, which can do good in good economies and bad economies both, 3.5%, 2.5%, not quite 1%, but still up more than 0.75% between those three. The only one that's down on a 5-day change is staples. The boring junk that we consider defensive plays, you know, when people want to keep their money in the markets, but everything else is down, they tend to go hide over there. Usually dividend names and, you know, low beta stuff that doesn't move much. That's okay, right? It's tradable. It's good stuff. Decent names, Walmart, Target, staples, you know, soup, ketchup. That's down. Everything else is up over the last 5 days. So the breadth in the broader market is turning around. Well, we're so close to triggering to the upside for a new leg up. But we still need that pivot to confirm, right? We don't have that yet. And a good place to watch for this kind of perspective is stockcharts.com. They have their own app, 24-hour TV, nothing but stock market. Or you can go to YouTube, stockcharts.com, and catch David Keller, because he just does a fantastic job with those McClellan summation indexes. It's really bugging me about TradingView. I rebuilt the scanner that had been broken, so we can identify the markets that are gapped up 0.5%, the ones that are up a full percent. But with it still not working here, it's working on my other machine, which is what's really driving me nuts. Then we don't have the then I don't have my scanner that I just worked through yesterday, got back online again. All right, so not much of a surprise. The KWeb constituents, JD, Baba, Baidu, they're down this morning. Airlines, well, all of these that are down less than 0.5%, we'll just consider them flat. But take it to the other side of the fence. We've got energy is up, bonds are up, and precious metals. So gold miners. I'm not seeing silver up enough yet. Looks like it's trying to work in that direction. So things like USO, getting a little bit of a dark pool print there, but USO is inside day breakout. A fantastic breakout, really, considering how it closed yesterday. GDX, gold miners. Now, generally, when we see miners running like that, we've got US dollar Japan working to the downside. Yeah, I mean, it's down a little, but not very much. Not enough to account for that move that we're seeing. But look at the 10-year. That's exactly what we want to see for an S&P rally. The thing is, here's a part of the trouble. The S&P is not responding to that 10-year move. Yeah, it's the one that says ADR multi-time frame. That's the one. So ADR multi-time frame. It'll have 3 moving averages in it. It has a table attached to it. And it's the highest download I would show you, but my trading view is not coming up for some reason. I can't even get the website version of TradingView to come up. It's really frustrating the heck out of me. Either way, this move in the 10-year should have given us a really nice backdrop for a move up in the S&P. And we are absolutely not getting that. And we still have the dollar pressing against yesterday's highs. So the dollar and the 10-year are really disconnected here, which is dangerous. And it screws up what we would normally lean on a day-to-day basis, right? Normally we see the 10-year moving up with the dollar moving up, energy moving down. And here we've got energy pressing highs, dollar pressing highs with the 10-year moving down. We've got US dollar Japan going down, even though we've got the dollar going up. That should be going up. So this is what is the threat today. I run two computers at once. So like right now, my other computer is showing TradingView just fine, no problem. But this computer, I can't get TradingView web. I can't get TradingView app. I can't get TradingView nothing. It's driving me crazy. So we do want to keep our eye on the bonds and the 10-year. Obviously, that's, it's moving around on its own. So those two are going to be their own tail. One runs inverse of the other. But keep them separate, and then keep your eye on the DXY. And the only thing I'd say to match it with is something like crude or gold. Because right now you got precious metals and crude and the Dixie all going up. That ain't right. So if we get back into sync with the dollar going down really fast, trying to catch up, we could see some strong moves in the S&P out of that. I would say that's the number one thing right now to focus on is what's happening with the Dixie. All right, there's a big expectation for today that we're just going to hold the line and go into the close. No, we don't want to, you don't want to look at it like that, right? It's not like a VIX where the VIX goes up, we expect the S&P to go down, or the VIX goes down, we expect the S&P to go up. It's not like that. It's more of how have things been working since the Fed started raising rates, right? And what we've been seeing is that a strong dollar or the Dixie moving to the upside and the 10-year moving with it has been negative to the market. So a rising dollar or a rising DXY, the Dixie, would be a falling S&P. But we don't want to say it normally does that, right? Because a year from now, that might not be the case. And a year and a half ago, that wasn't the case, right? Or 2 years ago. So it's the current backdrop. It's been this way for 10 months or so, maybe a little bit more. Last December, I was talking about a disconnect where for a while through last year, August, September, October, if the Dixie or the DXY moved, just 2 ticks up, the ES was moving 2 ticks down. I mean, it was a really, really tight inverse correlation. Then in December, it started to break and we started using levels instead. The dollar above, say, 105 would be headwinds, and we'd expect the S&P to have a hard time rising, that kind of thing. Now we've got this situation. This is completely different. So normalies and always and those kind of words, they don't fit here. This is what's going on in the current backdrop. The Dixie moving up or the DXY going up should be an S&P moving to the downside, or at least an S&P failing to go higher. But it's supposed to be matched, because we don't look at it by itself. It's supposed to be matched with the 10-year, that we should also be expecting the 10-year to go up. So there's this issue here right? We got the 10-year moving nicely to the downside. Why, with the 10-year falling like that, why is the S&P not running? Because the DXY is up. So this is shunting this move to the upside that we should be experiencing here. It's screwing everything up. And that's the threat right now. So if these two get back into their normal rhythm, where the 10-year is moving up with the dollar, or the dollar moves down to catch up with this 10-year move down, then we could see some wild swings in the market today. I think this is going to have a lot more impact on what we could get than anything else today, including those speakers that are out today. And Christine Lagarde is going to be one of those, and she's got some weight behind her words. So do the banks, Jamie Dimon and a few others. They've got a lot of weight behind their words. Otherwise, I think the market is going to go into the close trying to keep its position on the week more than anything else. And that's what I would lean on the most, is keeping that position for the week. All right, guys, have a good weekend. I'm going to reboot this machine and see what the heck is up with my trading view. I will see you all Monday.